Ready?
All right. Good afternoon, and welcome to the Patriotic Dragon Radio Show, January 21st. I keep trying to make it February. Uh, Welcome to the show, a show to bring open, honest, thoughtful conversation back, allowing individuals and groups to be a part of a better, brighter future. As always, the views expressed on the program are not necessarily those of the guests, WYYZ, Pickens County GOP, or the sponsor. The sponsor this month is Aspire to Inspire Before You Expire.com, a website to give people a place to express their aspirations and the people who have given them the drive to accomplish those. Our guest this week is Paul Kiker with Kiker Wealth Management. Paul, thank you for being on with us.
Thank you for having me. I'm excited.
All right. And for at least for a few minutes, our panelist to sit in with us, Bart Conley. Bart, thank you for being on.
It's always a pleasure to be here, Will.
All right. Well, Paul, I'd like to start out with with the tax season being upon us. What are some of the recommendations you would have for people trying to reduce their taxable income? And I just pulled off some things as far as Roth, IRA, that type of thing.
Yes. Well, when we get into that topic, especially this time of the year, one of the things I want to encourage people is if you're employed and your employer offers a 401k plan and you're not participating, that's not a very wise decision to make. So the greatest way for you to save individually throughout the year is straight into that company 401k plan. They can hopefully will have an employer match that's a bonus to you. So that's the best way. Now, if you're not eligible, your employer doesn't offer a 401k plan, a couple of different options depending upon your circumstance. Definitely a traditional IRA. You've got up until April 15th to do a contribution for last year. If you're under the age of 50, you can do $5,500. It's a deduction now, so you get a benefit now. You'll pay taxes on it later. If you're over the age of 50, the government cares about you being able to retire. So they give you what's called a catch-up provision, so you can put, not the ketchup you put on your hamburger, but catch up, an extra $1,000, so you can put $6,500. So if one spouse is working and one is not, you can still do a spousal contribution. So between the two of you, if you're over the age of 50, you can contribute, $13,000 into that plan.
Right.
For other individuals, my favorite investment for people that it makes sense for, there are some, depending upon your age, that it may not be the most effective, but I like the Roth IRA.
Okay.
I'm of the belief that taxes are only going to go up in the future. There was a time in our country, from my opinion, that we were managing money fiscally responsible.
The gold standard? No.
Yeah, at this point, it looks like mathematically taxes are going to go up. So the idea of me retire in a lower tax bracket, if you plan correctly, I don't think it's a good plan anyway. So I like the Roth because you don't get the benefit now, but you have tax-free income later. So those are the two that are the most widely available, and something that I would highly encourage each of you listeners out there to take advantage of.
Okay.
Do you see in the future the Roth IRA may be taxed? We're so far in debt as a country, taxes will go up that someone could say, well, we need to put a 1% tax on the Roth IRAs to get that, Have you heard anything like that?
No, I've heard people arguing that retirement accounts will be confiscated, forced into government securities, things of that nature. Of course, those are fearful ideas that people have come up with that could happen, but we've not seen any of that. I like to look at the back cover of the paper first.
Yeah.
There's always somebody will tell you, read the back page of the Wall Street Journal. If it starts working its way towards the front, you're at least 4 pages ahead of the average person. If it starts hitting the back page, I'll say, yes, that's a possibility. But we don't see that now.
Okay.
What I do see is a potential would be some type of forced conversion of retirement accounts to Roth, because that would generate a lot of income and revenue for the federal government.
Oh, okay.
But I don't see the Roths being taxed at this point.
Okay. And for our listeners who are local and work for smaller companies, can you explain, because I've talked to some different people about questions for the show and just in general conversation about the true difference between that company 401k and the Roth 401k as far as the match.
Okay.
I know it's free money, but I think a lot of people miss that concept of the value of that, and
Yes.
and what their cap is that they can contribute, that type of thing.
Yes. Well, there's a couple answers I'll give on that. First, when I go and meet and work with the employees of companies that I handle the 401ks for, the first thing I tell them is I don't care if your employer is contributing or not, you need to save at least 10% of your income. That tends to be a magic number. And some of the people that I've been the most impressed about are a lady that it took her 10 years to get to 10%, but she's at 10%. I can really respect somebody that works that way because she's going to have financial freedom at some point in the future. So what a lot of people don't realize is 401ks offered through your employer, now they have the option to give you traditional 401k, which is pre-tax dollars, or you can have the Roth 401k, which is after-tax dollars. Now, in the traditional 401k, the employer match is treated the same. When you participate in a Roth 401k, your contributions are tax-free at retirement, and you meet all the requirements after age 59 and a half in 5 years. But the employer match is treated like the traditional IRA or traditional 401k. So you're not going to pay taxes on it now, but you will pay taxes on it later. And that's okay because, it diversifies you a little bit. I tell clients I like you to have diversified income because even though I think taxes are going to go up in the long term, and I could argue that with near certainty, it's very possible, nobody knows the future, maybe taxes go down. So if you've got some tax-free revenue at retirement and some taxable, you're still going to be okay.
All right. And just for disclosure standpoint, I work for a multinational, and we're blessed with the fact that we have a 6% match, which is unheard of.
That's a big deal.
And exactly what you're saying with the lady, it took me 7 years to get from 6% match to get matching dollars to where I'm putting in the full 15% and getting their 6. And this year or last year in 2015, I started the Roth as well.
Good for you.
So, but you also got to be making that amount of money to be able to tell your wife, honey, one less movie this month or no movie at all. But,
that's right.
Yeah. But at my age, I figure it's a good investment.
It is.
So.
It's good. And I've never met a client that said, I wished I'd have saved a few more. Wished I had not accumulated this money. Everybody's, I wish I had saved more.
Yep.
Now, I have one client that I worry about because I tell him you can afford to actually go out to eat, but that's, the rarity. Most people just don't think about it. They don't realize the importance. And what I wish that when I go talk to high school kids or college kids, which I donate my time to do that on a regular basis because I would give anything to have known at that age what I know now.
Yeah.
And if I could breach confidentiality and actually sit somebody down for about 2 hours, and I wouldn't even have to breach confidentiality, but just say, look, this is what I see. These are the circumstances that I see. This is a consultation that I had with somebody today that is in retirement. They're barely making ends meet, and there's no end in sight for that.
Right.
Then I think people would pay more attention to saving today.
Right.
But the problem is, we're taught buy. What my kids are taught, I try to talk to them, save 10% of what you make, tithe 10% of what you make, spend the rest, enjoy it. But that's not what society teaches us. Society teaches us spend everything you got, borrow as much as you can borrow, and live for today. And all we're doing is pulling our purchasing power out of the future to today. So at some point in the future, we're going to have a void where nobody has any purchasing power.
Right.
So for those of you out there who will listen, and for those of us here, hopefully, we take that different path, you will be well rewarded for it in the future.
Yeah. Yeah.
You know, what do you do if you're in that situation where you don't have an income and you're starting to realize I don't have enough money? I mean, you just keep cutting back and cutting back and cutting back, 'cause, and you think you have enough, and I myself, I'm all right, but I look back and say, boy, I wish I would have done things different 20 years ago.
Right.
Thought I was saving enough, but it's.
Well, it's amazing because you look around and you would assume there's no inflation, but the cost of living keeps going up.
Yeah.
And that's crunching a lot of folks. And as I encourage people, sit down, put pen to paper, and really consider, there's hard decisions to make. I've had to sit through with individuals and everything I could do not to cry in the meeting, because I'm not going to do that in front of them. I've done it after they've walked out the door, just heartbroken for them, because, the only option was to sell that house that you've lived in for 30 years. And I know it's family property, but you've got too much house for the income you've got right now. You got to step back some. And, some that we advised in the past didn't, and they were forced into that circumstance when they met the inevitable end of the road, and some people dealt with it to begin with. But there's no easy decisions in that circumstance. It's tough.
And you said the cost of living, is going up, but the government said this year, last year there wasn't any increase. They didn't increase Social Security.
Right.
Which the increases are small, but it does give you a little bit more money every month. But, gasoline prices might be down, but food prices aren't going down,
That's right.
Taxes aren't going down. Medical bills aren't going down. And when you get older, you have some reason you have more medical bills.
I know.
Things fall apart.
And the cost of medical bills and expenses and insurance is just risen at an astronomical rate.
And, if you don't plan for it, when you're in your 40s and 30s, when you get to your 60s and 70s, you're going, oh, my God, what happened to my money?
Right. Well, I'll tell you, and it doesn't matter where you are in society right now, you're facing some pretty incredible costs.
Yeah.
So if you're at or approaching retirement, I'll tell clients that have saved well. I've had somebody just a couple of weeks ago came in, they're 58, they can afford to retire.
Yep.
If their insurance wasn't $2,000 a month.
Yeah.
So their hurdle to being able to retire is insurance that has gone up at an astronomical rate. Well, I've got 3 kids, my oldest being 17, and I have saved diligently for college and for myself. But the cost of college is going up much faster than I had anticipated at all.
Yeah.
So if you're young and you got kids getting ready to go to college, you're facing costs that are rising much faster than anybody anticipated. And if you're close to retirement, your health care cost is going up. So on the other side of that, our government gets to pick and choose the numbers they put into that index.
Yeah.
And most of the time it works to their benefit and not ours.
Yeah, we can make a whole nother show about that. So.
Right. Right.
Yeah.
So.
Okay. Well, and so now from where we started planning for 2016 and beyond, what are some of the best ways for people, and I kind of break it at that point, people above 50 years of age and those below 50 years of age, and you start wherever you want to, maybe at the 50 and under, what they need to really focus on trying to do.
Right. Well, let me start with the 50 and under. The 50 and under, the reality is it's pretty simple. Actually save some money.
Right.
I can count on my hands the number of individuals under the age of 45 that we work with. Now, granted, my account minimums are getting fairly high, but still, most people don't start saving until it's too late. Mm-hmm. So for under the age of 50, start doing something. Get to 10% of your income and make that your goal. And even if it takes 5 or 6 years, get there. And the sooner you start, the better. I had actually put some numbers together, and if I can find them here, because they're approximate numbers anyway, but I want to make sure I get them right on the ages. So let's say you're 22 years old. Time in the investment process is your greatest asset. Somebody once said that Einstein stated the greatest force in the universe is compound interest.
Yeah.
Okay, so these numbers are approximate because if you earn 10% interest, you're going to double your money about every 7 years and 2 months, and I just do 7 years because we're talking approximate, right? If you're 22 and you save $10,000 and you average 10% a year, okay, that's close to what the markets have done over 25, 30 years, mm-hmm. then you're going to accumulate approximately $640,000 by the time you're 65, okay? Because by the time you're 29, that 10 turns into 20. By the time you're 36, that 20 turns into 40. Now, the markets haven't done that for the past 15 years. We're just talking about averages, okay? Right. But there's also been periods of time where the market averaged 20% a year in the 1990s. So, same investment, okay? Same return. Let's just assume everything being equal. an individual at 22 says, I think I'll buy a nicer car and not save that money, by the time they're 36, they decide to save $10,000. They earn the same 10% rate of return, average. By the time they're 65, it's only grown to $160,000.
Wow.
That's a dramatic difference. So
Yeah.
when I go talk to college students and I tell them, I say, look, if you follow the advice that I'm telling you, there's no reason that you shouldn't have $1 million in the bank by the time you're 65. And saving is about freedom. It's about opportunity. It's about peace of mind. I can tell you, money cannot make you happy. Money cannot make you happy.
No, but the lack of it can make you miserable.
But it can make you comfortable. And the lack of it can make you miserable.
Yeah.
You know.
Yeah.
So good financial planning is crucial. When I go talk to companies, the first thing that I do is point out the employees that are participating. And I've got one company that I've worked with now for 16 years, and guess who's running the company? The employees who started participating 16 years ago.
Wow.
The ones who don't participate tend to turn over much more than others. Now, I'm not saying that that's always the case. You know, there's a difference between circumstances and rule of thumb. But saving is very important in time. So if you're under the age of 50, get started. Quit worrying about whether you pick the next Apple or Home Depot or whatever it is. Get started.
Right.
It's more important to get started than it is picking the perfect investment. So now, if you're over the age of 50, that's a great question. Okay. These are highly individualized answers, but I can give you some generalizations that'll help. One thing I did forget to cover, if you're under the age of 50 and over the age of 50, the most important tool that you can have, in my opinion, right now is an emergency fund.
Okay.
You need at least 12 months of your expenses in a savings account. And I know it's going to be making 0.1% or less. I don't care what it makes. This is why that's important. Let's say, I'll use a specific example. Had an individual come to work with us in 2008. Young fella. And I told him, I said, do you have an emergency fund? I won't take you as a client now if you don't have an emergency fund. And he says that he did. And he wanted to buy, let's just say, $10,000 of a particular stock, Home Depot. Now, I'm not making a recommendation, guys. I have to lay that out there. I'm just giving an example. Well, our tools told us that there was a high probability that the market would drop. Well, inevitably, market dropped. He lost his job. Well, he didn't have an emergency fund. That was a lie to me. So he puts $10,000 in a Home Depot stock, for example, loses his job late 2008, and he has to sell that Home Depot stock to pay his rent.
And you got $6,000 for it.
No, I got less than that, actually.
Oh, yeah.
So let's say it was $6,000. Well, was it the investment? Because today Home Depot is way higher than it was back then. I got active, y'all, and I hit his mic. But way higher than it was back then. You know, he'd probably have $20,000 just off the top of my head in that stock had he held on to it. So it wasn't a poor investment.
Right.
It was poor planning.
Yeah.
So the first thing you need is an emergency fund. That way, if this market does drop 30 or 40% this year and you do lose your job or you do have to continue to draw off of that investment, you're not forced to sell something at a loss. You give it enough time so that it can recover. So an emergency fund is important. Once you get that in place, the second thing I would do is develop a retirement plan. Most people have never actually sat down and thought about the income that they need, what inflation could do to them, and actually analyze their risks. That's one of the first things that I do to a client. Because most people look at investment advisors and they come in and they go, it's like going to the doctor. I've had people go, well, I don't want you to run a full retirement plan. Okay, this meeting's over. And the reason is, it's like you coming to me as a doctor and saying, Doc, I'm having some chest pains. And I say, okay, well, let me do an EKG and look at your blood work. And you say, no, just give me a pill to get rid of them. Okay? Any good doctor is not going to do that.
Right.
Yep.
So you really need to sit down, examine your plan, look at that and develop a plan. And that plan will help you to implement the strategy or an investments that will give you the highest probability of achieving your goals. So the one thing I will say is in 2016, I would be very cautious. And we can talk about that later,
Yeah.
but I would be very cautious this year.
All right. All right. Yeah.
Before you ask another question, Paul, I'm sorry to do this, but I am leaving.
That's okay.
I mean, so far it's been, very good answers, and I hope Will has some more good questions for you.
Well, thank you.
And I'll listen to the rest of the show when I can. But I have going to the commissioners meeting, make sure the commissioners are doing their job to take care of our future.
Keep them straight.
Well, that's impossible, but I'll try. Thanks.
Is.
Will, we'll see you.
All right,
Thank
thanks,
you.
Bart.
Good to
Thanks,
see
Bart.
you. Good to see you, Bart.
Right. All right. And then along that same line, on that 50 plus, or those of us who are already well past 50, and looking at 2016, no matter whether you read, the Atlanta Journal or Money News, or, I read about 4 different blogs in the morning before 6 a.m.
Yes.
But as far as a strategy, when you say to be cautious, where would you say if I'm quote well diversified, if I've got percentage of company stock, I've got some energy stocks, healthcare, consumer type things, and bonds? Because I know what I did, and I don't have to disclose what I did, but
Right.
I made a 30% shift in my portfolio to bonds, and luckily I did it between Christmas and New Year's.
Yes.
So, but what do you think as far as a strategy for 2016, as far as still want to be diversified, but
Yes. Well, the strategy for 2016 really depends upon the strategy that you've chosen. Now, that's hard for me to answer because our strategy right now, and since the first of the year, is we're 100% out of the stock market.
okay.
Now, our strategy is designed to let us know when risk levels are high. It doesn't tell me which way the market's going to go.
Right.
It just tells me that this is an environment where there's a high probability that the market could go down. So since the first of the year, as of today,
Yeah.
we look like a genius. I'm not a genius, guys. We just have good tools. So our strategy is specifically designed to adapt and change. So I can tell you exactly why we buy what we buy and exactly why we do what we do. Now, I can't tell you what the outcome is going to be, but I can show you. So our strategy would be a little bit different than somebody who goes to a major investment firm. Okay, typically they work off of modern portfolio theory, which there are no buy and sell decisions. Okay, so the way they deal with volatility is through diversification. So what I can tell you is if you're the type that's going to panic if this market drops 30% and sell, then you really need to question whether that's the strategy that you're comfortable with.
Right.
If you're a Warren Buffett, for example, Warren Buffett doesn't spread his eggs across like modern portfolio theory does. He's a value strategist, so he's looking for a specific set of stocks. Well, last year Buffett was down more than 12%.
Right.
The strategy struggled. That was just a weakness of it.
Right.
So choosing that strategy is important. But what I would say, in my case, we're not going to spread it across the board. We're going to be very targeted. We're going to manage risk. The great thing about that is if the market goes straight down from here, we've held our levels. The bad thing about our strategy is if the market turns and goes up 20% tomorrow, we're still sitting in cash.
Right.
Okay, we'll adapt, but we're not trying to pick the top and the bottom.
Right.
What I can say is your strategy needs to be really determine whether you're comfortable in the investment process that you're operating under. Okay? If you're comfortable in that and the market drops 50% and your portfolio goes down 50%, then you need to stay the course. Okay? Because what about the people who panicked and sold at the bottom of 2009? It's easy to sell when the market's dropped 50%. It's easy to buy when the market's up 50% and your neighbor's bragging about how much money he's making. But we can't make emotional decisions in the investment process because that is what will destroy you.
Right.
And like you and I were talking before we got on the show, for you readers out there, I have actually been looking in our portfolios to put a portion of the money to work because I'm expecting a 30, maybe 60-day market bounce before we go back down the other way. But I have a specific tool that has to give me the green light before I do that. So what we were talking about, Will and I were talking about before the show, I told him about calling a dear friend of mine that we talk 3 or 4 days a week. He's an advisor too. We've been on this journey together. I said, Joe, I want to buy today because I think the market's going to jump 300 points tomorrow. And I said, what do you think? And he says, okay, well, that sounds good. And I stopped right there and I said, okay, Joe, you're supposed to tell me that we're not doing anything till our strategy gives us a green light. And he goes, yeah, that sounds good. He was distracted. He would have never let me do it. And I said, okay, Joe, so you're a great psychologist because I've called you, shared with you what I was thinking about doing, and gave myself no answer. And now the people that I've worked with are better than that, but we joke about this back and forth. And so we didn't do anything because our rules didn't, and of course the market dropped 500 points the next day.
Right.
My point is emotions, even with professionals, can get you in trouble if you don't have a plan. Intuition is a good thing, but you got to have a strategy. So for you investors out there planning for 2016, the best use of your time is to sit down with your advisor and say, okay, if the market tanks 50%, what are you going to do? If he says we're going to stay the course, that's okay, because if that's what his strategy is designed to do, then you better stay the course.
Right.
If you're not comfortable with that, then maybe you need to look at some other options and choose that strategy.
Right.
Choose a different strategy.
Yeah, because I actually had a listener send me an email, and it was kind of talking about the price of not crude, but the price of gas, the price of crude oil. And she was like, well, I wish that gas was back to $4 a gallon because my 401k was higher. And I didn't really want to go into a long, conversation with her about the fallacy of that thought process. But, I had a lengthy set of emails today about the economy in the 90s and what's different today.
Yes.
And, the investors, there weren't what I call consumer investors really in the 90s. It was primarily, it was the large investment groups, that type of thing. And there were virtually no Chinese consumer investors at all in the market. And we weren't tied to such a global economy. So, I think there was probably 25 or 30 emails and notes back and forth between me and about 10 other people. And I finally kind of got an agreement across the board that things have changed. That's all it is. That's the way the economy, and that's when you're tied to the world economy, you're going to get those wild swings.
Oh, yes.
Yeah. And a lot of people don't realize just how superstitious the Chinese investor really is.
Very. Very.
Yeah.
And understandably so. Well, I had a client that was a lobbyist. Told me 15 years ago he went over to Europe and heard the most impactful long-term strategic planning speech that he's ever heard in his life. And he came back and he said, Paul, based on what they're telling us and the trends, we're getting ready to see an equalization of the nations over the next 15 years. And he said, what that means is our power in the United States is going to be weakening, and the power throughout the rest of the world is going to be strengthening. And we are seeing that.
Right.
Now, granted, China has its own issues, but I like to remind people right now that, they're blaming the market route on China, and China's slowing down, and they make it sound like China's separate from the United States and we're great. But if most people will think about it, what does China do? They manufacture for the rest of the world.
That's right.
If the U.S. is that strong, then China shouldn't be that slow, because don't we buy most of our things from them?
That's it.
So maybe that's an indication, kind of the canary in the coal mine of things may not be as strong in the next 12, 24 months as what we think it might be. Now, I don't know.
Right.
And that's okay, because if the facts change, I'll change my stance.
Right.
But as of today, I do have a lot of concerns about the economy.
Yeah.
And I think China could be a reflection of something that is not fully revealed on the surface yet.
Yeah. The underlying economic issues are there, and the EU has tried their programs, and I see, I've got two siblings who live in Europe. Mm-hmm. And our brother-in-law lives there as well. So one's in France, two are in Germany. So you hear that perspective of it as well.
Yeah, I would love to hear their perspective as to all the changes they've faced in the past 12 months.
Yeah,
incredible.
Yeah. And even more so than that, over about the last 4 years, as they've really struggled with the Greece, the Cyprus, and all the propping up of those economies that they really can't regulate.
Yes.
That you regulate from afar. And, their numbers they're auditing their banks and everything tighter than we do here, like we talked about earlier, as far as our numbers of unemployment, who's really unemployed, that kind of thing. What the government counts and what the real world counts is different.
It's
It is.
two completely different things.
And that's that underlying thing that you're not able to see.
Yes.
When 93 million people are out of work, they don't go to Walmart nearly as much.
No, they don't.
And they don't buy stuff from China nearly as often.
Well, what's fascinating is I was reading the reports last night. I can't remember the exact numbers, but Walmart's shutting down 250 plus stores,
Right.
laying off approximately 10,000 employees. Now, I can't quote the source that this came from, but I did read that last night. So let's just say this is a rumor at this point.
Yeah, no,
I think it's announced,
Yeah.
but I have to be careful, guys, when I'm saying that, because if I don't know all the facts, I have to. I'm 99% sure that it was 256, I think.
Mm-hmm.
But the point being is that's reflective of why are they shutting down those stores? Consumers may not be spending as much as they are because Walmart's been consistently plodding along over the years.
Mm-hmm.
So I don't know if it's just a transitioning of our economy, and maybe we're building a base to where we're going to lurch forward and higher economically and in the markets over the next 5 years. What my belief is that whatever the move is, it's going to be very big. Maybe a very big move down, maybe a very big move up.
Yeah.
And it's important to be flexible right now. At least we have a strategy that allows me to be flexible.
Right.
For everybody else, I would be open-minded, because if we have a big breakdown, it's going to change society as we know it. But there are going to be more opportunities than you will have ever seen in your lifetime for those people who are in the position to take advantage of them.
Yeah, absolutely.
Yes.
Yeah.
So be wise, be prudent, and if it happens, you can't control it.
Right.
But have a mind that puts you in a position where you want to take advantage of it.
Yeah, yeah, and I just read in the past week or so before we did the show, as I was doing some research, that an estimated with the baby boomers alone, approximately $47 billion that they have is not in the market at all right now, because they're at that point where they're sitting, it's all in bonds or it's in a cash position, all that. So yeah, there will be that opportunity when the bend at the end is your friend.
Yes.
That those people at that retirement age can come back into the market and help stabilize it, help grow it back.
Yes.
So for the younger investors, pay attention to what your grandma says.
Yes. Well, and one thing I'll say too is we have been taught that the older you get, the more conservative you should be.
Yeah.
When you look at historical numbers, and what we do when we run a plan for somebody is I actually take their income, their assets, where they are. I'm taking a snapshot of where you are. Let's assume your life expectancy is 92. Now, some people argue with me all day long, I'm not going to live that long. And I said, okay, let's say you die at 80 like you think you're going to. Okay, only God knows when we're going to pass away.
Yeah.
But let's say you die at 80, but you think you're going to die at 80. We plan for that. I say, okay, you'll run out of money at 83. What if you live to 95? How miserable is that going to be?
Yeah.
So I'd much rather plan that you're going to live to 92 and you pass away at 80 than to do the other way around.
Right.
And I lost my thought process there for a moment.
No.
Think that's
notes.
part of life, right?
That's the reason we do notes.
But the point being is, I lost it. But the point being is through good plan. What I do anticipate we're going to have going forward is higher levels of inflation.
Yeah.
And so I do think it's prudent. If you look at a plan, come to see a professional like me, look at your retirement plan and see what a 3.5% inflation rate would do to your income. What would a 5.5% inflation rate do to your investment plan? Those are scenarios that we stress test against individuals, and we may never see them, but if I sit down with you and show you what your risks are to success,
Right.
I'm actually going back and stress testing you against the Great Depression, against World War II, against the 70s, and I can show you, okay, you would have been successful in this environment and not in this with the same strategy.
Okay.
Now we know what we need to worry about.
Right.
It may not be a Great Depression. It may be above average inflation. And as a professional, I am more terrified of above average inflation and what that'll do to retirees than I am a Great Depression.
Yeah, and for all those, like you say, you still are going with inflation. Great Depression, people can cut back. They can do all that.
Yes.
But when bread goes to $4 a loaf, because
Right.
of inflation. It doesn't matter how much you cut back.
Right.
Yeah. So
Well, the Great Depression was deflation. So
Mm-hmm.
when you have a strategy like I operate under, we're 100% out of the market right now. None of our portfolios have any market exposure. So even bonds, we don't own bonds right now.
Oh, okay.
So if the market was to drop 70%, that's deflation like happened during the Great Depression. We can prepare for that, and we've done it conservatively and prudently. However, let's say we break towards 10 or 12% inflation. There is no conservative way to fight off inflation. You've
Okay.
got to be aggressively invested.
Okay.
And that's the reason why I'm more concerned about above average inflation, because when I run scenarios with most clients,
Mm-hmm.
if they plan prudently, if we had another Great Depression, a major market decline, it's going to hurt them. They'll
Right.
probably run out of money in 15 to 17 years if they've got a good plan, but at least it's 15 to 17 years from now.
Right.
If I run a 5.5%, 6.5% inflation stress test on these same clients,
Mm-hmm.
if they keep up with inflation, they run out of money so fast it's scary.
Wow.
And so we have contingency plans in place for all of our clients. If we get there, this is what we're going to do. And they know that. They know what we're going to do.
Right.
Mr. Client, I don't want to carry this much risk with you, but we won't have a choice if inflation gets that high.
Yeah.
And they understand that.
Okay.
So, it's important to think about that, because that is what concerns me in the future.
Sure. Okay. Good deal. Now, next one and stuff is one of our panelists, Stephen Halls, is a true millennial.
Okay.
Right out of college, and works for the state senator Barry Loudermilk. But he's a poli-sci major, so we give him a lot of hard time. So, but for those millennials that do listen, and Stephen, you and Adrian, what would be your advice for them going into 2016, other than kind of what we've already talked about? But the millennials that I'm talking about are the ones that are out of college, out there in the workplace, and some of them with student debt.
Yes. Unfortunately, it's nearly impossible for the average family to get have a child get educated with the cost of college now without accumulating debt. It's horrendous. That's a major issue we have in our country. We've got to figure out how to fix.
Right.
So if you're a millennial, it's all about foundation. You've got a choice. And the choices that you make today are going to dramatically impact your future 10 and 15 years from now. And that's one of the things I always explain to my kids. If you choose to pursue the drug crowd, then you're going to reap the benefits of that. Mm-hmm. If you choose to pursue discipline, you're going to reap the benefits of that too. I believe that we should have the freedom in this country to choose our path and suffer the consequences, whether they're good or bad.
Yeah.
So as a millennial, lay the foundation. The most important thing that you should do right now is to target a 12-month emergency fund. Okay? Because let's say we have a bad economy. You're young enough to survive. You're going to be okay. Yeah, if it's bad enough, maybe you lose your house or something like that, but you can get another one, and you've got an opportunity to rebuild. It's not the end of the world if that happens. It's the end of your prideful world, but it's not the end of the world. So you need to prepare that emergency fund, because we're going to have major global changes coming forward. And you need to be in a position to where if you were out of work for 12 months, you can pay your bills without having to liquidate your investments. So target that, set 12 months as your goal. I advise most millennials don't start investing until you reach 6 months. Now, that's hard, because if you've got an employer that matches 6%,
Sure.
okay, we got to blend that.
All right.
Get the full amount of your match, and then take every other penny you've got and put it in the savings.
Okay.
Once you have that in place, then you should be taking that 10% and funneling it towards your investments.
Mm-hmm.
I would also set a plan to stay out of debt. Okay, you've got to get out of debt. I don't believe that it's okay to borrow money to buy a toy. Borrow money to start a business that can pay off the debt. Yes, most people have to borrow money to buy a house, but don't go borrow money to buy it. And today you got to have a car. Cars are expensive. You're probably going to have to borrow money to buy a car. But you can borrow money to buy an affordable car or a really fancy car.
Yeah.
Yeah. You don't need to be driving a car that's nicer than your, the average 50-year-old when you're 25. I know you want to do that, but the point is keep your debt low and stay out of debt. And what I see for you millennials is you're not going to see the benefits of that for 10 years, but all of a sudden 10 years later you're going to look up and you have less debt and you're able to do things that other people aren't, because they spent all their money early, and now they're struggling. So emergency fund, save into that 401k, 10% at a minimum once you get that emergency fund in place. Don't count 10% as your match. Count 10%.
Okay.
And I know in most cases you don't feel like investing aggressively because it's hard to save that money, but the younger you are, the more aggressive you need to be.
Oh, okay.
Now, of course, legally I can't say that fits everybody because everybody's circumstances are different. You need to go see an advisor. Remember, I'm not your advisor. I don't know your circumstances. But as a general rule of thumb, if you're 35 years old and the market drops 50%, doesn't matter. Keep saving because you're buying more shares.
Yeah.
And it will recover at some point in time, or at least it has historically, and that'll be an opportunity for you. So invest aggressively because there's a huge difference between having the opportunity to have that money double every 7 years. At 10%, it's about 7 years and 2 months. Well, right now, if you're conservative, you're going to get 1 on a CD.
Yeah. Yeah.
Government treasuries for 20 years are paying a little over 2. At 2%, it's going to take you 35 years to double your money.
Yeah.
Your money needs to be working as hard as you are.
Right.
So, and seek out professional advice. That's one of the things I've learned in my career. I love what I do. I enjoy doing what I do. Now, there are aspects of my business that I don't enjoy, and I ask the Lord from time to time in my prayers, God, why did you put me in this business? But I do love it.
Yeah.
I don't do my taxes. I have a professional accountant that I hire. I hire people that are specialized in what they do because it gives, I interview them. If they're skilled, I'll hire them. Now, they're not going to be perfect, but I have them working for me, and I'm surrounded with advisors, and 2 minds are better than 1.
Right.
So those are the advice that I would encourage as a millennial to pursue. It's going to be a different path than the majority of your friends are walking.
Yeah.
I mean, even at my age, I'm walking a different path than most people my age are trying to.
Yeah.
And it's not easy. But it will be well worth it down the road.
Yeah. Well, and for those millennials that are out there working and double income, no kids, and you were managed to buy that 3-bedroom, 3-bath house, there's nothing wrong with a roommate that pays rent.
Right.
Find somebody, if they only live there a year while they're getting their self started, it helps to pay your monthly bills, and that the room's just going to sit there and collect other stuff if you don't rent it out.
Yes.
So a lot of people forget that. They want to have their house and set it up and just the two of them. But if you buy the house and there's a spare room, rent it out.
Rent it out.
Yeah.
And there's nothing wrong with stepping up. I'll tell you, I'm speaking from experience. Now, I'm a financial advisor. And when my wife and I first moved back to this area to start our practice up here, there was a couple of decisions we thought was important. We prayed about it, and she wanted to stay at home, and I wanted her to stay at home, but we were starting over from scratch. I'm walking away from established practice in Middle Georgia to move up here.
Okay.
So we had a nice home down there. Things were great. And my father had always advised me most marriages fail because of financial difficulties more than they do anything. It's stress you don't want to have on your marriage. So I told Holly, I said, look, let's go buy us a repoed double wide. We've got some family property up in LJ.
Nice.
And let's live there for 3 years. Cost us $150 a month plus our power bill to live.
Wow. Yeah.
So we did. And bless my mother-in-law's heart, she was in tears. But we moved back up here. Now, first of all, I'll tell you, that was the greatest time that I've ever had in living because our expenses were low. She stayed at home. We didn't go out to eat. We didn't do anything.
Yeah.
I worked and came home. Several years later, we saved up some money. I bought an office building. We still lived in that little double wide.
Yeah.
A couple years after that, we took some extra saved money and we built a house that we ended up selling, and then we're in our place that we're in now. So the point is I know the benefits of starting out. I could have afforded more than that double wide.
Yeah.
But let's say I had $1,000 a month instead of $150. That's extra stress.
Yeah.
That was extra money that would have been taken away from going into the business that we were building.
Right.
And it was one of the greatest decisions I ever made. And
Yeah.
you find out who your friends are real quick when you step back in a home too.
Oh yeah.
So
Well, if you got property where you can ride a 4-wheeler, I mean, so that's
yeah, that was even more fun. But start small.
Yeah.
Start small and build. Like the sun rising until noontime. It's glorious when it comes up over the horizon, but it just gets more beautiful and more impactful until it reaches noon. And that's the way we want to build our lives as a millennial. Build a good foundation and grow from there. That way you don't have to, if you stumble, you don't fall flat on your face and lose everything.
Right.
So
Good. Okay. Well, now I want to kind of talk, not necessarily political, but it is financial. How do you feel about the Fed will handle interest rates with China, with the oil prices where they appear to be headed? And where do you think the bottom price on crude is, or on crude?
Well, there was a time in my career I would have probably given you a number on oil. The more I learn, the more I realize it's impossible to pick the bottom. You've got fundamentals, and you've got psychology, and you've got emotions, and what I can tell you is about 3 years ago, our tools told us to avoid commodities at all costs. That the path of least resistance was down. And when I looked at that, I thought, we'll probably see a 30% decline in commodity prices. And I acted on that. I had some precious metal investments that I ended up selling. Told clients we thought the price was going to go down, but I thought it would go down 30. I told clients 10. Just stay away from it. Of course, I would have argued with you all day long that we would have never seen oil prices this low.
Right.
So there's factors out there right now that looks like it can go lower, and when the information looks like the prices can go nowhere but lower, they may in the short run, but that's probably pretty close to the turning point. Right. So I would say that unless we had a major deflationary event and the economy slow down, we're probably pretty close to the bottom in oil, but I wouldn't buy it yet.
Right.
That's not a recommendation to purchase it. If we saw oil prices drop another 50%, then you better watch out, because that's signaling major deflation, and I would be very surprised if the markets didn't follow very quickly behind it and catch up with it.
Yeah.
So now, the second part of that question, so to answer your question specifically, I have no clue how low it'll go.
Yeah.
We may already be there. The first part of that question is, how do we think the Fed will handle interest rates?
Right.
Yeah, that's a really good question, and a lot of people in our industry are talking about it. And the people that I pay for their opinion, their belief is the only way that we know what the Fed will do is to look at what their statements have been. Bernanke got teased about being Helicopter Ben because he stated that if we were faced with another Great Depression, they would print money from helicopters. Now, did he really say that? I'm not sure. I didn't see that in writing, but that's what people I trust say that he said. So the Federal Reserve raised rates after postponing back in December. The belief is that the U.S. economy is good. I think they were backed in a corner, because if they didn't raise rates, then the market panics because all of a sudden the economy is not as good as they thought it was.
Right.
If they do raise rates, then maybe sentiment is okay, the economy is good. What we're seeing now is the market is selling off, which may or may not be normal. If the market continues to sell off, which it is a leading indicator, the big question is whether the Fed's going to raise rates at the next meeting. My belief is, and those of people that I find to be very wise, is if we had another recession and the market was to drop 30 or 40%, that the Fed will probably start printing more money. My concern is that they're going to say, well, hey, it worked well from 2010 to 2014, so how about we do as much as we did then all at once? And so I'm afraid that we're going to see an environment where market drops, the Fed prints a whole bunch of money, thinking that it's going to work again, and we end up with above average inflation on the other side. Now, I'm not going to say hyperinflation because that's a currency event.
Right.
I could build the argument that might happen, but that's a little far out there right now. But I do think that we could see above average inflation, and I'm not so sure that it'll help the markets. So we're just going to have to wait and see. But the governments of the world right now want to print first and ask questions later.
Right.
And more of the same. The definition of insanity is doing the same thing over and over again and expecting different results. So they'll probably print.
Yeah. I think they'll print before they raise.
Yes.
Yeah.
Because they're already talking about negative interest rates in Europe.
Right.
There's a Fed chairman here, or may not be a Fed chairman, I'm sorry. There are members here, economists here in the United States, that are promoting negative interest rates. And this is actually on the back page of the paper. Okay, so this is mainline. This is potential. These are people that have the power to make sure this happens, or influence public opinion. Are talking about negative interest rates. There's actually talk of, well, if we have another big recession, the government printed all this money and it went to corporations, and it didn't make it to the average person. So there's people out there speculating now that the government would print money and hand it to the average person. Now, will that happen? I don't know. Is this conspiracy theory? I don't know. It's out there.
Yeah.
But these are topics that people are actually discussing at high levels and respectable economists.
Right.
So I've got a feeling that we're going to see more money being printed in some capacity if the economy falters. And I do think the economy is going to falter in the next 12 months.
Yeah.
With the information I have right now.
Right.
Now, will it be a recession as bad as 2008? I don't know. I don't think so. We could have a minor recession and major market reaction because the market is a little artificially elevated based on historical fundamental values.
Right.
So it'll be interesting to see how it pans out.
Yeah. Hopefully those economists that are thinking about making those decisions are actually seeing what China's been doing.
Yes.
And maybe learn from it instead of replicating it.
Yes. Yes.
That would be a good start.
It was quite fascinating, to what I think China's market was open 8 minutes or however many seconds it was, before it shut down for the day with a 7% decline.
Yeah, with the kick out on it. And
Yeah.
they did it too. I think they did it twice, and then they decided to take the kick out off of it. And I thought that was going to be the worst day, and it was actually not nearly as bad as the first two. I think it's when they realized it wasn't automatic, then they all took a breath and went, okay, let's think about this a little bit.
Well, with the way the triggers were set, it was a stampede for the door.
Yeah.
When they opened it up, they said, okay, market forces can be there. Maybe I can sell later in the day. Let's just see how this happens.
Yeah.
So I think it was a wise move for them to open those parameters up a little bit.
Yeah, I do too. Because again, you got to test the market somehow, and that's how they chose to do it. So, but next thing, Steph, what do you think how the bonds will perform against other equity markets? And we've touched on it a little bit, and more specifically, I think would be. I had two different listener stuff ask me about to ask you the question as far as municipal bonds with tax benefits versus corporate bonds.
Yes. Well, historically, I have liked municipal bonds. I'm not a fan of municipal bonds right now. We've got Puerto Rico, who may or may not default on their debt. They are tax-free bonds. There's a lot of municipal bonds funds that have Puerto Rican bonds.
Oh, okay.
The government charter, from what I understand, does not allow Puerto Rico to file bankruptcy or structure their debts.
Oh.
So if they defaulted, the question is how far is that going to ripple across the municipal bond market?
Right.
So municipal bonds are a good tool, but I'm actually scared of all bonds at this point, whether it's corporate, whether it's municipal, because we've been seeing interest rates decline for over 30 years. Imagine a seesaw on the playground. When interest rates go up, bond values tend to go down.
Yeah, down.
You add to that record levels of debt and cheap money out there. We haven't yet started to see major defaults because of oil prices dropping. There are a lot of companies out there that don't have the revenue that they used to have with oil prices dropping, but their debt levels have stayed the same.
Right.
The question is, are we going to see defaults there? And if that starts rippling across, who else can it hit? There was a period of time in 2008 where bonds dropped well over 15% in the aggregate bond index. So I just don't think the risk reward in the bonds is very attractive right now.
Okay.
I have a little concerns about the fiscal responsibility of state governments. And, you've got insurance on the companies. Some of these bonds are insured.
Right.
But still, I would rather sit on the sidelines and see how it pans out.
Right.
If I could get an 8% return, it may be worth it.
Yeah.
But if you're getting 2 to 3%,
hadn't found that one.
Yeah, if you're getting 2 to 3%, is it really worth earning that right now? Or are you better off just take a deep breath, kind of sit back and see? Now, guys, remember, I have a strategy that dictates these decisions for us, and that's
Right.
driving my opinion.
Sure.
If you're a buy and hold strategy, do not walk away from a bond just because I'm sharing an opinion.
Right.
Because my strategy dictates my opinions. If you're in a modern portfolio theory strategy, then that strategy should dictate your opinions, not me.
Right.
I'm just saying that it's going to be a very challenging environment, and I'm concerned that it's going to be so challenging that I've turned away a lot of business this year. I've had clients come in to me and say, Paul, I got this CD that's maturing. They want to pay me 1.5% for 5 years or whatever that number is. What can you get me on bonds? Well, Mr. Client, go buy a CD.
Yeah,
Come
really.
see me in a year.
Yeah, renew it. Renew it.
Well, why? I don't like that category, and I would rather you go somewhere else for a year and not be mad at me over something I can't control.
Right.
I'd rather do without your business in that bond category. Now, if you want to talk equities, good. You want to do a 70-30 portfolio, 70% equities, 30% fixed income, 60-40, 100%, conservative growth. But if it's pure fixed income, if all you want is replace those CDs with bonds, I don't want to. I don't want to take that risk on right now.
Right.
I think it's going to be a very tough and challenging environment.
Yeah. Yeah, and that's the question I asked back to the person who's posing it to me about the bonds and looking at municipals. I said, well, Georgia is a state that actually has a balanced budget on the books. I said, that would be my first situation. I said, you're looking at, he named off some state bonds he was looking at. I said, Georgia, we're very fortunate, and what allows us to have the standard we do is having a balanced budget state lets you have the tax-free on the bonds in Georgia as well as tax-free on the federal money from them too. And he was looking at some other states in Ohio and a couple others, and that was when he actually looked at them. He was like, oh, yeah, they don't run a balanced budget. I said, then why would you lend them more money to be, to handle it poorly? I said, So, yeah, I think that eliminated all but like 3 states
Yeah,
that he was looking at. So.
You take Illinois or some of those others, and see, here's the problem. Those states, if they're spending too much money and they don't have a balanced budget, well, one of two things is going to happen. Either they're going to collapse, okay, because you can't borrow yourself into wealth. It just doesn't happen.
Yeah.
At some point, your revenue is going to drop and your expenses are going to stay high, and you can't pay your bills, and that's a default.
Yep.
Well, let's say they get to that point and the federal government prints a bunch of money. Well, printing more money is inflationary. The problem is this money hasn't caused inflation yet. That's why we're in the problem we're in. So if they print money to be inflationary and inflation jumps to 7% and you're earning 3% on a 20-year bond, well, you're going to lose in the long run and you might lose in the short run. So why jump into that game?
Right.
Now, that's my opinion.
Yeah.
6 months from now, if they're selling for 70 cents on the dollar, I'll buy some bonds.
Yeah, really. Yeah, really.
I don't know that that's going to happen, but the point is from my strategy perspective, we would rather just wait and see how this unfolds. Sometimes doing nothing is the best choice.
Yeah. Oh, and we're getting close on the time stuff, but I do want to just, what are the services that your firm offers at Kiker Wealth Management? Just kind of run through so that customers, and I want you to make sure and give your phone number, contact first.
Yeah, we do a little bit of everything, but there are 2 things that make us unique. When you come in to see me as a client or a potential client, the first thing I'm going to do is run a retirement plan analysis on you. We're going to stress test it against history like I told you before, and I'm going to show you where you are currently and your probability of success. Then we're going to develop a plan that gives you the highest probability of success. Better outcomes is what we're all about. Okay. So the first thing, you're going to get a full retirement plan analysis. The second thing is we have a unique strategy that is designed to mitigate risk at certain times. It's not perfect. Every strategy has its unique set of strengths and its unique set of weaknesses, but we can explain that clearly to you. So that's our specialty. Now, in addition to that, once you become a client, your plan is tailored specifically to your needs. And as I tell people, I don't give you a questionnaire that says what you want. I show you what you need. And if what your risk tolerance is different than what you need, then we'll change something to get you there.
Okay.
But so the good thing is we're not selling you what you want. I'm not interested in that. I want to help people. You don't help people when you give them what they want. Now, sometimes that works, but you know what I mean? Sure. What they really want is a successful plan, not to be sold a product. And we're fee only. So in addition to that, we do life insurance, estate planning, bonds and stocks and ETS and mutual funds, all of those things we do, but it's
Okay.
really individualized. Whatever you need as an individual, we take the time to work with you and help you accomplish that. So for one person, it may be they need life insurance. For one person, may not need it.
Okay.
It's truly unique. So we do pretty much everything. I mean, I've advised clients on car loans and mortgages, and
No, really.
I've sat in on closings with clients before and things of that nature, and I've helped clients with attorneys. We bring the attorneys in because I'm not an attorney, right? To do special needs trusts for disabled children,
Oh, great.
things of that nature. So it's truly unique to you. So if I gave you a list of everything we did, it's about 4 pages long.
Yeah. No.
But it all starts with you.
All right, and for people to get in touch with you, the local phone number and maybe the website. If you got it
Yes.
that way.
Local phone number is 706-253-7285. Again, that's 706-253-7285. My email is pretty easy. It's Paul, Paul, at Kiker Wealth. And our website is www.kikerwealth.com.
All right.
So, hey, we would be honored to have the opportunity to compete for your business.
All right, Paul. Thank you for being on. Really do appreciate it. And with that, we'll sign off.
Thank you.
All right. Perfect. 1 hour and 33 seconds.
Wow, that went by fast.
That's what it's hard to. Hey, darling, there's my bride.
Right there. I didn't hedge too much on your questions, did I?
No, you were no.
Okay.
Yeah. No, and that's why I say I don't expect anybody to give anything other than, because that's the reason I say at the front, it's everybody's opinion.
Yes.
And because it's and you'd have to listen to some of our other shows. So if you go on the Facebook and
Oh yeah, but it's fine. I ate it all.